Welcome to Stock Incubator. Today we are breaking down the market question behind this story. Every AI investor talks about chips, models, and data centers. Fewer talk about the thing that can stop the entire build-out cold: power. Bloom Energy just got tied to a $25 billion Brookfield framework, and it says it delivered an Oracle fuel cell system in 55 days. That is the hook. If AI factories need electricity faster than the grid can provide it, Bloom Energy providing the bypass lane. But after a huge stock run, the question is brutal. Is Bloom Energy the power layer behind data centers, or is the market already pricing perfection?
Every AI investor talks about chips, models, and data centers. Fewer talk about the thing that can stop the entire build-out cold: power. Bloom Energy just got tied to a $25 billion Brookfield framework, and it says it delivered an Oracle fuel cell system in 55 days. That is the hook. If AI factories need electricity faster than the grid can provide it, Bloom Energy providing the bypass lane. But after a huge stock run, the question is brutal. Is Bloom Energy the power layer behind data centers, or is the market already pricing perfection?
The main story is not clean energy. It is time to power. A data center can have land, buildings, chips, and customers, but if power is delayed, the revenue is delayed. Think of GPUs like planes and power like the runway. You can add more planes, but if the runway is blocked, nobody takes off. Bloom's pitch is that behind-the-meter power can create a local runway faster than waiting for the entire grid to catch up. That is why the stock is being re-rated. Bloom is no longer being framed as just another green energy name. It is being framed as a potential speed solution for AI factories. Keep that phrase in mind. Speed solution. That is what the market is paying for. This is why the video has to avoid the lazy headline of green energy stock. The better frame is logistics. AI infrastructure is a supply chain, and power is the bottleneck node. If the bottleneck gets removed faster, the customer can monetize GPUs faster, open capacity faster, and sign workloads faster. That is why time to power can become a premium product.
The re-rating started because the customer problem became obvious. AI data centers need reliable power at a scale and speed traditional grids were not designed to handle. Brookfield called behind-the-meter solutions essential to closing the grid gap for AI factories, and Bloom became Brookfield's preferred on-site power provider in the original $5 billion AI infrastructure partnership. Then the story escalated. Brookfield and Bloom expanded the framework to $25 billion. That is the institutional signal. On screen, this is where I want the viewer to see the $5 billion number turn into $25 billion. The market did not just react to a press release. It reacted to the possibility that Bloom is now inside the capital stack of AI infrastructure. The screen should show 3 layers stacked together: power, capital, and compute. Bloom alone solves only part of the stack. Brookfield adds the capital layer. The customer gets a clearer route from project idea to operating infrastructure. That is why the stock reaction is understandable even if the valuation later becomes debatable.
Before we go deeper, let's ground this in the physical product. Look at the screen. This is not a chatbot company. Bloom provides on-site electricity generation using solid oxide fuel cell systems. The customer is not only receiving equipment, the customer is securing power that can sit closer to the data center load, reduce dependence on slow grid upgrades, and support mission-critical uptime. The reason AI customers care is simple. If a normal grid upgrade takes too long, behind-the-meter power can help a site turn on sooner. Bloom's promise is not that it solves every energy problem. The promise is that it can reduce the time gap between building an AI data center and actually powering it. The key phrase is behind the meter. That means the power solution sits on the customer side of the utility meter, instead of depending entirely on the grid to deliver new capacity. For an AI campus, this can matter because power availability is not just an engineering detail. It can decide when revenue-producing compute comes online. That is why the physical product explanation needs to appear early in the video.
Now look at this financial breakout on the screen. Q1 2026 revenue was $751.1 million, up 130.4% year-over-year. Product revenue was $653.3 million, up 208.4%. That product number is the key. It says customers are rushing to secure capacity, not just paying for a slow service stream. Gross margin reached 30%. GAAP operating income was $72.2 million, compared with a loss in the year-ago period. Non-GAAP operating income reached $129.7 million, and operating cash flow was positive at $73.6 million. So the old bear case that Bloom is only a future story with no cost scaling better is much weaker now. But do not close the loop yet. The revenue is accelerating, but wait until the Oracle chapter, because the 55-day deployment is the proof point that explains why customers may pay for speed. For the visual, split the screen into two bars. One bar shows total revenue acceleration. The second bar isolates product revenue. That second bar is the story. Services can bloom energy sticky, but product revenue is where the rush for capacity shows up. Then show the operating income flip from negative to positive. That visual tells the viewer Bloom is no longer only presenting a dream, it is beginning to show scale economics.
Management also raised the bar for the full year. Bloom guided 2026 revenue to $3.4 to $3.8 billion, and the company said the midpoint now implies about 80% year-over-year growth. Non-GAAP gross margin guidance is around 34%. Non-GAAP operating income guidance is $600 to $750 million. Look at those three lines together: revenue growth, better margins, and cost scaling better. That combination is why the stock stopped trading like a sleepy energy equipment name. But a raised bar cuts both ways. When the market prices a company like a category winner, every quarter becomes a proof window. The next report is not just about growth. It is about whether growth still arrives with margin discipline. But this is also where the script should slow down for one sentence. Guidance is not revenue already collected. It is management's best view of the year. The market will now compare every update against that higher baseline. If the company hits it cleanly, the AI utility narrative strengthens. If it misses, the stock can reprice faster than the business actually deteriorates.
The Brookfield framework is the anchor that makes this story feel institutional instead of promotional. Bloom and Brookfield expanded their AI infrastructure partnership from $5 billion to $25 billion. Brookfield is not simply financing hardware. It is increasing a framework to finance power projects for AI infrastructure globally. This matters because infrastructure scaling often fails at the capital layer. Customers may want power, but they also need financing, project structure, site execution, and operating discipline. Brookfield brings capital and infrastructure development. Bloom brings the on-site power platform. Together, they're trying to offer an integrated AI factory model: power, compute, data center infrastructure, and capital design from the beginning. That is a bigger story than fuel cells alone. This is also why the word framework matters. It is not the same as immediate revenue, and we should not pretend it is. But it gives the market a larger map of the opportunity. Bloom is trying to become a repeatable power solution inside a financing structure that can scale project by project. That is the institutional mode. Not just technology, but repeatable deployment plus capital access.
Now close the open loop from the financial section. Oracle is the cleanest proof point in the entire video. Bloom said Oracle intends to procure up to 2.8 gigawatts of Bloom fuel cell systems under a master services agreement. An initial 1.2 gigawatts has already been contracted and is deploying across Oracle projects in the United States. But the retention number is this. Bloom says it delivered a fully operational system to Oracle in 55 days, more than a month ahead of the anticipated 90-day schedule. That is the chart I want on screen. 55 days versus 90 days. If time to power is the crisis, This is Bloom's strongest evidence. The bull case is not just that Oracle likes fuel cells. The bull case is that Bloom may help Oracle unlock AI capacity faster. This chapter should Bloom Energy one of the biggest visual moments in the video. Put 2.8 gigawatts on screen first. Then put 1.2 gigawatts already contracted. Then smash 55 days versus 90 days. That sequence makes the point without needing a complicated explanation. Scale plus speed is the entire thesis. If either one fails, the bull case weakens. If both hold, the stock earns at least part of its premium.
Equinix gives the story operating credibility. Equinix said it has an agreement to expand Bloom's solid oxide fuel cell deployment to more than 100 megawatts at over 19 data centers in 6 states. It also said it has been using fuel cells for more than 10 years in collaboration with Bloom. This matters because it prevents the story from sounding like a brand new AI experiment. There is installed base history inside real data center environments. Show this visually with existing data centers, on-site power modules, and uptime dashboards. The point is not that Equinix removes all risk. The point is that Bloom has already been part of mission-critical digital infrastructure before this 2026 AI hype cycle exploded. This installed base chapter is also a credibility reset after the Oracle hype.
Oracle proves urgent.
Equinix proves operating relevance. Those are different kinds of validation. One says customers need power now. The other says Bloom's technology has been used in real data center operations for years. Together, they reduce the risk that the entire story is just a one-week market narrative.
The bull case is straightforward. First, AI power demand is growing faster than traditional grid timelines can comfortably support. Second, Brookfield gives Bloom a capital partner that can help turn power projects into financeable infrastructure. Third, Oracle gives Bloom hyperscaler scale validation. Fourth, Equinix gives Bloom data center operating history. Fifth, the Q1 numbers show that the demand is already hitting revenue, product sales, margins, and cash flow. On screen, this section should look like a 5-point bull checklist. The conclusion is not that Bloom will own the entire power market. The conclusion is that Bloom may Bloom Energy becoming one of the fastest deployable power layers for AI data centers. That is why the stock is being treated like AI infrastructure, not legacy clean tech. The bull case also depends on customer diversity. If the story rests on only one hyperscaler, the risk is high. If the story spreads across Brookfield, Oracle, Equinix, utilities, semiconductor manufacturing, and other mission-critical customers, the market has more reason to treat Bloom as a platform. That is why each customer proof point matters.
Now change the screen. Go from green data center power visuals to a red volatility chart. Before anyone gets hypnotized by the $25 billion headline, look at the stock. Current market data shows Bloom Energy around $289, with an intraday range from roughly $286 to over $331. That kind of daily swing is not normal utility behavior. It is momentum stock behavior. If the stock has surged roughly 1,000% over the past year, the market is already assuming massive execution. The bear case is not that Bloom has no demand. The bear case is that even a strong company can become a dangerous stock when valuation leaves no room for mistakes. This is the objective advisor segment. Story quality and stock risk are not the same thing. This is the retention reset for skeptical viewers. Anyone who was thinking the video sounded too bullish should feel the tone change here. The screen should become darker, the chart should become red, and the narration should move from opportunity to risk. The point is not to scare viewers. The point is to earn credibility. A high-quality business can still punish late investors if expectations become unrealistic.
This is where we separate headlines from scorecards. A $25 billion framework is powerful, but investors still need to track how much becomes signed projects, delivered systems, recognized revenue, backlog, margins, and cash flow. Bloom's own risk language points to the hard parts: upfront costs, financing needs, debt obligations, manufacturing defects, supply constraints, installation delays, interconnection delays, regulatory changes, and the risk that AI data center adoption slows. So the watch items are very specific. Remaining deal value, operating margins, operating cash flow, product gross margin, delivered megawatts, customer concentration. If growth remains high but margins compress, it could mean Bloom is sacrificing profitability to scale. That would change the quality of the story. Also watch the difference between announced capacity and recognized revenue. A project can Bloom Energy announced, contracted, installed, and recognized across different timelines. That timing gap is where volatility lives. The market may celebrate a framework today, then punish the stock later if revenue recognition, margin profile, or cash flow arrives slower than expected. That is the exact kind of detail long-form viewers appreciate.
Bloom is not the only solution. Data center operators and utilities are looking at gas turbines, grid upgrades, batteries, renewables, nuclear options, and hybrid power systems. That actually makes the story more credible, not less, because it confirms the power gap is real. The market is not searching for one winner. It is searching for fast, reliable, financeable power wherever it can Bloom Energy found. Bloom's advantage is speed, modularity, and behind-the-meter deployment. Its risk is that competitors may offer cheaper, larger, cleaner, or more familiar solutions for some customers. So the right bull case is disciplined. Bloom does not need to own all AI power. It needs to own enough of the urgent time-to-power problem to justify the premium. This is also where Bloom's community-friendly argument matters. Dense urban or suburban data center projects can face pushback around noise, emissions, land use, and grid strain. Bloom argues that its fuel cell systems are clean, reliable, scalable on-site electricity that can Bloom Energy attractive in places where traditional combustion-based backup or power expansion becomes harder. But every market will have different economics and regulations.
So here is the final verdict. Bloom Energy has transitioned from a speculative clean energy story into a serious AI infrastructure power candidate. The reason is simple. Data centers do not run on hype. They run on electricity. Bloom's strongest evidence is the $25 billion Brookfield framework, Oracle's 2.8 gigawatt agreement, the 55-day deployment proof point, Equinix operating history, Q1 revenue growth above 130%, product revenue growth above 200%, and raised 2026 guidance. The caution is just as clear. Bloom Energy is highly volatile, the valuation is stretched, and physical infrastructure execution is hard. My conclusion for Stock Incubator is this: Bloom made Bloom Energy one of the most important time-to-power trades behind AI data centers. But the next proof window is about delivered megawatts, margins, and framework conversion, not just headlines. This information is and does not constitute financial advice. Always do your own due diligence around valuation, volatility, and market risk. The clean final scorecard should stay on screen for the last 30 seconds. Remaining deal value, operating margin, product gross margin, operating cash flow, delivered megawatts, and customer concentration. If those improve together, the AI power layer thesis strengthens. If revenue grows while margins or cash flow weaken, the story becomes more complicated. That is the balanced conclusion viewers need.